How does the federal funds rate impact economic interest rates? Have you ever wondered how the interest rates you see every day are influenced by decisions made by the Federal Reserve? Let's break it down in a simple way. The federal funds rate is the interest rate at which banks lend reserve balances to each other overnight. This rate is a key tool used by the Federal Reserve to guide monetary policy and affect the economy. When the Federal Reserve adjusts the federal funds rate target, it has a direct impact on short-term interest rates across the economy. Banks use this rate as a baseline for borrowing costs. So, when the federal funds rate changes, it sends ripples throughout the financial system. This means that other interest rates, like those on loans, mortgages, and bonds, will also change. For instance, if the Federal Reserve raises the federal funds rate, it becomes more expensive for banks to borrow reserves. Banks typically pass these costs onto consumers and businesses by increasing interest rates on loans and credit. As a result, borrowing and spending tend to decrease. This slowdown in economic activity can help control inflation. On the flip side, when the Federal Reserve lowers the federal funds rate, banks face reduced borrowing costs. This encourages them to lend more, which can lead to increased spending and investment. Such actions can stimulate economic growth and boost employment rates. The Federal Open Market Committee meets regularly to set a target range for the federal funds rate. The Federal Reserve then employs various tools to keep the actual rate within this target range. These tools include adjusting the interest paid on reserve balances and conducting open market operations, which involve buying or selling government securities. The influence of the federal funds rate extends beyond short-term rates. It also affects longer-term interest rates based on market expectations about future economic conditions and monetary policy. Changes in these rates can impact consumer decisions on spending and saving, business investment plans, and overall economic activity. In essence, the federal funds rate acts as a benchmark that shapes the cost of borrowing throughout the economy. By adjusting this rate, the Federal Reserve can influence economic interest rates broadly. This, in turn, affects inflation, employment, and growth, making it essential to understand these decisions within the context of economic and monetary policy.